To the man who keeps more money in my pocket each year. Hello, Matt. How are you?
Good, Zenia, going well. How about yourself? No, there's a lot of traditional accountants out there where, unfortunately, they're still strapped in that mindset of we need to do timesheets and we need to bill for every single bit of time we put forward to clients. What I always say to clients is when you treat GST, you need to think of it as it's not really your money, it's the government's money. And unfortunately, that's just the way it's been set up in Australia. So that's the best way to get your head around it initially. The first thing I see a lot of people kind of missing, especially in their kind of summaries they send over to us, is the shortcut method. Now, the second method is to go about claiming the actual cost of running that home office. So the second thing I encourage a lot of clients to do is contribute to your superannuation. Another kind of thing to be wary of as well is depreciation. I think the first thing to understand with a company is you might get to a point where I want to switch to a company because I want to save on tax. Once you switch to a company, it's very, very different to get money out. Using your credit loan is first and foremost the most beneficial. But then when a credit loan's kind of tired and you're down to that zero value and start to creep into more of a debit loan, that's when we need to start being more wary of paying yourself wages or dividends.
Welcome to Swift Coaches Academy, a podcast dedicated to bringing health and wellness professionals the uncensored truth behind what it really takes to succeed in the health industry with me, your host, Zenia Wood. As an accredited exercise physiologist and business owner for almost a decade, I'm on a mission to transform the lives of ambitious health professionals like you who want more and are ready to take action to create incredible impact in your careers and unlock financial freedom in your business. So join me as I speak candidly with industry leaders about the struggles and successes from within the trenches through thought-provoking conversations.
To the man who keeps more money in my pocket each year. Hello, Matt. How are you?
Good, Zenia, going well. How about yourself?
Yeah, great. So today we have my incredible accountant. And I feel like I should probably start with like how I ended up choosing you or coming across you, and then we can sort of dive into your story. And I don't even know if you know this, but I used to have an accountant before you, and he charged me like $80 for an email that he sent, that his VA sent to me, that took like 2 minutes. And I was like, are you fucking kidding? Like, I asked you one, like, when, and this was also like, it wasn't like, oh, hey, by the way, to answer this question, I'm going to charge you. It was just like, oh, here's the bill. And I don't know, I mean, you'd probably have a better idea of this, but I don't know if that's still kind of like somewhat standard in the industry, but I think that's fucked.
Yeah, I mean, just quickly on that, there's a lot of traditional accountants out there where, unfortunately, they're still strapped in that mindset of we need to do timesheets and we need to bill for every single bit of time we put forward to clients. And whilst 100 years ago, that was fine, coming into the modern age now where you're trying to maintain relationships and people want to chat online like we are now or over the phone, you just can't be billing for every minute you work. So, yeah, it's definitely one of those bit more archaic processes, I would say, in the industry.
It was wild. And even before I knew of you through my previous business coach before I started with you. And I kind of like approached him and I was like, yo, like, why don't we do like a monthly like retainer so that I can just ask you what, and he was just like, no, we can't do that. That's not how it's done. And I was like, but I know people who do that.
Yes.
So
Yeah.
how about I don't give you any money? So that was how we sort of came into contact. But I'd love to have you maybe explain what we've sort of alluded to already in terms of like the model that you have at the accountant firm that you're partnered with.
Yep, of course.
Yeah, so maybe talk to me about that and why and how you're different.
Yeah, absolutely. It's a great question. Look, I think we're the epitome of doing things differently. So I work for ProYou Business Advisory. I've just become a partner actually just over a year ago now. Look, in that time,
Probably from all those referrals I gave you.
it has helped. It has definitely helped, Zenia, and we appreciate that. But look, ProYou now has been operating just over 4 years, and we've come from that traditional accounting firm in the past where you bill for every minute. You really only see your clients maybe once, twice a year, if that. And if you want to able to ask us any questions, most of the time clients will reply, I'm afraid to call my accountant because of what they're going to charge me. Or maybe not say they're afraid, it's they're afraid of what we're going to say to them because we don't have that ongoing relationship. And there might be all these things that pop up that we have no idea about, and it's just chaos. So essentially our managing partner and a few other partners that are still here at ProYou Business Advisory stepped away from that business model about 4 years ago now. And in that time, we set up ProYou Business Advisory. And the reason we set this firm up is to kind of attack and kind of attack accounting in a different way. doing more compliance work, doing all the tax returns, charging for our time. It was archaic. Yes, it's our bread and butter, and that's where most accounting firms make their money. But where we see more value is the actual business advisory side of things. And to sit here today and hear clients say, oh, I was afraid to call my accountant because of what they might charge me. How does business advisory flourish and grow from that? So the way we tried to change our model was we encourage clients to set up on a monthly retainer, whereby that monthly retainer is inclusive of any phone calls, any emails, any kind of external quick meetings that they'd like to hold, just so we're continuously on top of their business and also able to understand what they're going through on a regular basis. Because 365 days, it's a long time. And there's a lot of things that can happen throughout the year. New opportunities arise, new issues arise, a whole variety of things can pop up. So by having that model, we're much better able to keep that, I guess, flexibility open, and also better able to access our clients' records and understand on a timely basis what they're going through. And we've had great success in that overall.
And I really love it. I think perhaps it could be like a little bit nerve-wracking for people who are maybe newer to business or whatnot. But I think realistically, having that person, just like actually the same thing with my lawyers and my legal team, and they don't do the charge per minute either, which is awesome. And I just feel like to have that peace of mind that you are on tap, you have my back, and I can ask you whatever. I think that is far exceeds the like retainer that you charge. And I cannot even like count the amount of times where I've just been like, oh my God, I don't know what I'm doing, or this is not working. And like to give you and Pancho, who is I think one of the directors, right?
That's correct.
Yeah.
Yep.
To give you guys huge raps. Like you guys have spent so many like hours on the phone to me, like just making sure that I feel confident and everything's happening by the book, and that like if I don't understand the maths, like I really love and I've said this to you so many times, like treat me like I'm 5 when it comes to accounting and tax, because I'm like, I need to start from ground zero, and I'm going to like interrupt you mid-sentence and be like, I don't know what a dividend is and what's a franking credit and how do I, like manage this situation, whatever it is. And I just feel like if more people were able to access a model like this, then I think our businesses would thrive better, because most businesses go under because they don't manage their cash flow. And that's what an accountant should be doing. And if you're afraid to talk to your accountant, then I feel like you probably don't know your numbers very well. Or you're just trying to do it by yourself, and then, compliance and other things, and you get, audited by the ATO, or you get a tax bill that you don't know where it came from and you can't pre-plan. There's just so many benefits to having someone on tap. So that's my huge wrap for you.
I really appreciate that, Zenia. Like, and just to add on that too, like our exposure to that many different industries, that many different business owners, that many different business models, we've probably seen it before. If not, if it's something you think's new, we've probably seen it being done before in the past. And at least by knowing that, we can guide people through all different walks of life and able to kind of assist where needed. So absolutely, I definitely implore, I think accountants are definitely the most useful tool for any business owner, but having the right accountant that can definitely tap into more of that business advisory side of things, that's where you see the most value, that's for sure.
And so talk to me about what your definition of business advisory is, because I think some people might be a little bit confused by that term.
Yeah, of course. So for me personally, business advisory is switching our clients from being passive accounting types to more active accounting types. So what I mean by that is passive accounting is whereby clients live what we call on a gross basis daily. So whereby whatever money comes in, they just say, oh, sweet, I've got income. Let's just spend it all on this, this, and this. Let's get the rent up to date. Let's get insurances up to date. You know what? Let's just pay myself because I want a brand new car. And all of a sudden, the next month, they're sitting there going, I've now got no money because I haven't planned for this, and I didn't forecast that this month was going to be poor. So in honesty, I work with a lot of clients that step into mainly sole trader businesses and start off on their own under an ABN, and that's kind of the day-to-day process of what they go through. And I can understand, like, as soon as you start seeing money coming through the door, you get excited. You're like, oh, I could spend this now, and I need to pay this guy and get him up to date, and that's fine. But on a longevity basis, you're not going to probably last at that rate. So what we try to do, and where I kind of see the most value when it comes to business advisory, is we encourage clients to step away from that thinking and more into that active accounting model. Now, what I mean by that is active accounting is making use of accounting reports at your access. So if you're currently using an accounting file, if you're still trapped on Excel, that's still just as fine. As long as you're across your numbers and you're across also a bit of a forecast of incoming income, as well as expenses that are forecasted for the future, you're better able to kind of react to fluctuations in your business. So if you have a down month where, some clients left or sales were just lower because it was December, it's Christmas holidays, whatever it may be, you're better able to plan for these times and better able to put money aside, or better able to go hard in those months where you're going to make more money and be able to perform a little bit better. In saying that as well, active accounting also ties into tax, being, approachable and being understanding of when an activity statement's going to come up, when you need to pay super, when you need to pay staff. Just being across all those items allows you to be a little bit more active in your business and a little bit more better to, be receptive of advisory that an accountant's going to provide to you. If you're more on that passive accounting kind of mindset, business advisory is probably not going to benefit you too much, because you're probably going to sit there going, I don't really need a budget. I don't really need to forecast, because look at all the money I have and I'm just going to spend it all. It's going to be great. But active accounting, you really get to build on our relationship and really get to understand the processes that we're liking to you to kind of follow going forward.
Totally. And I feel like passive accounting too is like waiting for the bill to hit and then being like, oh my God, now I have to find the money, versus forecasting or budgeting or planning. And I think something that you've taught me is to be able to predict with like reasonable accuracy. Obviously, like GST inclusive or exclusive can fluctuate, but to put aside what you need for tax and to have that, like I have it in a separate bank account that I just do not touch. Yeah. And it's like it's like not my money, right? Like, and I think like when you typically start out, maybe you have one business bank account and it's like blending your personal and your business expenses. And like the first thing I recommend is making sure that people split those. But like, what are some things that common mistakes that you see business owners doing that you like to help them transition to, so that they're being more active with their accounting or their forecasting?
Yeah, absolutely. I think number one is, I think you just touched on it perfectly. It's just having that one bank account and using that one bank account to pay for everything and anything, and using it as a savings account at the same time. It gets way too convoluted. You've got no idea what's in there unless you're tracking it all on a separate Excel sheet. My brain's already hurting just talking like that. I just think that...
And you're the accountant who loves the numbers.
Because I say it that many times, and it really pains me, because just setting up an additional bank account, for most banks it's free, and we highly encourage it. Just having a separate, what we call a bucket bank account. Zenia, I know your businesses do that excellently. You've got obviously your operating expense account, where you just have enough money in that account to pay for all your daily expenses that keep your business running. Might be rent, it might be insurances, might be a whole variety of other items, but that would be the main purpose for that. And then we quite often see other clients, just like you touched on, having an income tax account set up, a GST account set up, a wages account set up, a super account set up. The purpose of all these is just to put enough money aside as a bit of a buffer to cover these types of expenses. And as time goes on and you get better able to understand your numbers, you'll also start to learn how much money needs to be put away into each of these accounts. And what you'll find is, like you touched on earlier, you just leave that money sitting there and you'll find it just pays itself off as it goes. And then any money that's left on top, you start to just take home either as a profit or either as the wage to the director. And that would be my first recommendation to get out of that kind of hole that I see a lot of clients making that first mistake. I think a second really, really big mistake for a lot of clients is just not understanding tax whatsoever. And like, I get it. It's something that a lot of clients probably just go, that's my accountant's side of things. I don't even need to worry about it. And for a lot of people, that's fine. Like, you can have that peace of mind and still run a very successful business. But I think you need to understand like the core competencies of tax and really understand not just how it all works and how it ties into your business, but what kind of effect it can have on you in the future down the line. The big one a lot of people obviously understand is income tax. So I'd like to hope a lot of people understand that. It does vary from when you're obviously trading at a personal level. And when I mean personal, just under your individual name, under an ABN. And it does vary when you decide to set up a company and operate out of a trust. Whatever it may be, income tax operates differently in each of those entities. And that's where you can lean heavily on an accountant. But understanding how it all ties in and what rates you're paying is definitely the questions I'd be asking to your accountant to best understand what money to put aside. Other taxes that some clients might not be aware of is obviously goods and services tax. So at the moment, it's 10% of tax on goods and services sold or consumed in Australia. So for a lot of clients in the fitness industry, maybe not so much in the more chiropractic kind of space or more in the physiology kind of space, because they can be sometimes claimed as GST free. For a lot of kind of personal trainers, a lot of just gym owners in general, a lot of the sales that are being made are GST inclusive. And what a lot of people will do is they'll operate for however long, just when they first start up. Their sales by the end of the year will have exceeded that threshold of 75,000. And then all of a sudden we come knocking along and saying, oh, well, you're going to have to register for GST now, and you're going to have to plan for this going forward. That's another tax that a lot of people don't really understand. I think the best way to understand it is goods and services tax. It's 10% of your overall sales. So, for example, if you made a sale of $110, $10 of that amount is going to be inclusive of is GST essentially, and that needs to be paid back to the tax office. And what I always say to clients is when you treat GST, you need to think of it as it's not really your money, it's the government's money. And unfortunately, that's just the way it's been set up in Australia. So that's the best way to get your head around it initially. Like I said, you've got to be earning over that $75,000 threshold to actually register for GST, but it's really important just to have that in the back of your mind before you hit that threshold, just to be aware of that. And you can, of course, register for GST before you hit that threshold, but for most clients, it's best to wait.
Okay,
look,
I just on that. So you wait until you hit 75,000. You don't have to pay anything back, or like, let's say you earn 100,000 in your first year in business. Are you then, for that extra 25,000, is there any penalty for that?
Yeah, so we usually find that once you hit the crux of that $75,000, so it might be, you might start trading in July, you might not hit it till you hit April, say. That's when you'd probably have to register for GST and start to pay GST from that. So if you don't find that out till the end of the next financial year, there would have to be backdating for that, and only up to that first point where you should have been registered at 75,000. For a lot of clients, though, I do often say, if you're looking to do a massive fit out before you start operating, or if you're looking to purchase cars or whatnot, just to get your business operating, that's when it's beneficial to register for GST, because a lot of the credits you can claim back through the form of GST on those expenses is really beneficial for cash flow.
Gotcha.
And look, without boring everyone too much, there is also various other taxes that I won't delve too much into. There is obviously pay-as-you-go withholding tax, which is just tax on wages that are paid to staff or even to directors themselves. And then there's other taxes such as payroll tax, fringe benefits tax. I won't delve too much into because it's more for your accountant, and you should be leaning on them to best understand those types of taxes. But just so you know, there is a variety of others that need to be wary of, and they might not apply to all business entities. They might not apply to all business owners, but they are there and they can be triggered depending on what actions some people take. So I'd probably say they're the two biggest, misconceptions or errors that a lot of business owners have. There is a third and final one, and that really comes down to your business structure. And once again, I think it's perfectly fine if clients, when they first start off a business, they don't understand business structures, because it's not that's not your bread and butter. It's not where you make your money. It's not what you should need to know if you're depending on your accountant to advise you of that. But just being wary of what's the best entity I should be operating in before I start my business is one of the best questions you should be asking an accountant. You need to factor in things such as, would you like people to buy in future? Would you potentially like to grow this business and sell in the future? Is asset protection very important to yourself? Do you own a lot of property or just investments personally where you'd like them to be a little bit more safer when it comes to operating your business? All these questions you need to be asking your accountant, and at least having a bit of a timeline and a plan, I guess, of where you see your business in the future. And that way, at least you can set up and kind of form the foundations to have a successful business, not just from a cash flow perspective, but also from a tax perspective as well.
Awesome. So I'm going to ask a couple of questions on that, and then I think it might be useful to also dive into like what we've done too, because I was just like, let's start a business, ABN, woo! And then sort of like when we were, a year or so in, then we started talking about like a trust. So I think it might be useful to have you explain what that is, and I'm more than happy for you to sort of explain why we transitioned me to a trust as well, because that might help people. Would you be able to do that?
Yeah, absolutely. Absolutely. So I guess to first and foremost understand, your situation, Zenia, obviously trading out of a company, we need to recognize a company as a separate legal and tax entity. Now, that's a lot of words. The best way to understand that is a company is a separate being, essentially. It can enter into contracts. It can invest in shares, property. It can operate your entire business, retain all the earnings from that business, and it's almost like the director or the actual shareholder never had to lift a finger or do anything. That's how we like to recognize companies. They're completely separate to a director and the shareholder that has shares in that company. Now, in saying that, with a company, because it's a separate legal entity and a separate tax entity, when it comes to asset protection for especially shareholders and especially the director, for most of the time, especially if there's no personal guarantees on any bank accounts or any investments in the ownership of the company, the director and the shareholder are pretty safe in that regard. And what I mean by that is a lot of the personal assets held by a shareholder or held by a director and especially in their personal names, are going to be protected if anything bad happens to the company. So what I mean by bad is if there's ever any kind of legal issues in future where, a client might be underserviced or any wrongdoing, if there's anything that bad that happens to the company and there needs to be some kind of payable in the due course of legal findings, at least the shareholders and directors can comfortably sit here and say, well, my assets are protected. And I don't need to worry about selling my personal family home. I don't need to worry about selling all my personal portfolio of shares or property, whatever it may be, to cover those legal findings. So that's first and foremost, I guess, the benefit of a company. The second benefit of a company is, of course, the tax rates. In Australia, for a lot of small business entities and especially base rate entities, you're only paying tax at 25%. Now, 25%, for a lot of people, that still might be too high. A lot of people do say to me, but 25% is a lot less than what we see than the average income earners in Australia. It's a lot less than their personal tax rates that they're having to pay, which at the moment are anywhere from 30% all the way up to that 45, 47% tax rate. So it's a huge tax saving when it comes to operating out of a company. Now, I wouldn't just encourage everyone and anyone just to set up a company just for the benefit of this. What we've seen is there really is no benefit to operating out of a company unless you're making more than $110,000 profit a year. So that's not revenue, that's more so profit.
Right.
So that's just something to bear in mind for a lot of business owners. For a lot of business owners, if you don't have a lot of other investment income, if you don't have a lot of other wages that you're receiving on top of your ABN income, it's normally best not to make that jump to a company. But for asset protection, it's definitely a great idea to jump to that company. So you've got to kind of weigh those two things up and see where is most beneficial. Now, just on that topic, when it came to your situation, Zenia, and operating out of a company, you had the asset protection, you had the kind of really advantageous tax rates, you were earning it over the threshold that we definitely recommend for a lot of people to be operating out of a company. Where we kind of encourage the setup of a trust, and especially the setup of a trust acting as a shareholder to the company,
Hang on a second. I'm just going to pause you because I feel like we might be going down to some words that people are like, oh, so let's just backtrack for a second.
Of course, yeah.
So just to clarify, obviously you're talking about setting up a company as opposed to working as a sole trader. So that's
Correct.
the first, sort of like the first step, I guess, in terms of
Yes,
becoming
yep.
like a PTY Ltd.
Yep.
And that means that I can keep my money in my business, and the money that's in the business only gets taxed at 25%. And, expenses that I pay for with that, I won't be charged anymore. I don't need to take it out, pay myself personally, and then go and buy something for the business because then I'd pay more tax. And then, so there's sole trader. Let's say we've transitioned to a company for the fact that I bought a house in my personal name and I don't want someone to take me for that. And be able to take my house off of me. Why then go to a trust?
Yeah, absolutely. I think it's a great question. Now, without jumping too far ahead of myself, when it came to setting up a trust for yourself, we needed to first of all have that initial discussion, like I touched on a bit earlier in the call, in regards to what you wanted for the future. And I remember you came to me, Zenia, and you said, look, eventually I might want to sell this business. Eventually I might want to have someone buy in as a third party. I don't know yet. I don't know what the final outcome is going to be, and that's perfectly fine. But at least you had that thought and you wanted to start planning for that. And what we did essentially was, right, well, if you wanted to sell your business in future and, not only just that, but maybe you wanted to have an investor buy in and you still want to have some part ownership, what we recommend to a lot of clients is setting up what we call a trust. Now, what I encourage for a lot of clients, especially when they first start off switching from an ABN to a company, a lot of clients will just go ahead and say, well, I don't have a family at my young age. I don't really have many personal investments. I'm just going to list myself as the personal 100% shareholder of the company. And what I mean by that is their personal name will just be listed as the shareholder. So going forward for a company, if that shareholder ever says, well, there's some retained earnings in the business has been quite profitable for a couple of years, I'd like to dip into that and take a dividend, for example. Now, Dividends is a whole nother topic and it can be quite convoluted, but to kind of sum it up, a dividend's really just shareholders, I guess, owning their right of a portion of the retained earnings and taking that out in a different form other than what we call wages, in the form of what we call a dividend. And it's essentially taxed at their personal rates when that is eventually flowed through to them. And for a lot of clients, that's fine if you're paying dividends that aren't too kind of not so much catastrophic, but not going to impact your personal tax situation very much. But for a lot of clients where a business is very profitable and earning a lot of money, especially in a company, when you pay a dividend and you've just got your personal name as the shareholder, all that money is then taxable at your personal tax rate. And what we say to a lot of clients is it's not very beneficial, especially if you've got a partner, if you've got young children, where your partner may not be working or your children might be of an age where it's beneficial to distribute a large portion potentially to them, mainly because just of their lower taxable income compared to a director's taxable income. So what we encourage for a lot of clients, and especially yourself, Zenia, was to sell your shares in your personal name to a trust. And that trust is still in the ownership of yourself, but where that trust acts a bit differently to a personal shareholder is that trust will step in and take ownership of those shares now. So on paper and physically, that money, I guess at the end of the day, especially if you don't have any dependents or any kind of beneficiaries under you or any children or whatnot, at the end of the day, that money still gets flown through to yourself and you still have to pay personal tax on that. But by having that trust, not only have you added an extra layer of protection to yourself, but at the same time as well, you've now opened the possibility of in the future, if you ever were to get married, if you ever were to take on a spouse in future, if you're ever to take on children, if you're ever able to list a number of beneficiaries that you'd like to distribute income to, you now have the benefit and the flexibility at least to spread that kind of tax effect across those beneficiaries. Now, the type of trust that we recommended to yourself was a discretionary family trust. Now, the reason for that is in a discretionary family trust, you have the ability, or the trustee has the ability, and the trustee is essentially they almost act on behalf of the trust as the owner, I guess you could call it. They act on behalf of the trust's beneficiaries to make sure they manage the investments, they manage the income, but they also manage the income distribution at the end of the year. Now, by having this trust, Zenia, you are much better able to now kind of, if needed, allow for an investor to buy in and sell down shares if you ever wanted to, and you're better able to now flow and at least be more flexible with spreading out the effects of a dividend or the effects of a capital gain. Whatever it may be, you're now a bit more flexible and a bit more receptible to any kind of fluctuations in that business's future.
Awesome. I'm going to try and recap this in I'm 5 years old speech, just in case anyone got a little lost, but I think you did a pretty good job, to be honest. So I have a trust which puts another layer of security between, if anyone, was to legally come after me or the company or whatever. Yes. So I'm removed again. But then you mentioned being a shareholder. So just to, I guess, explain a little bit more, hopefully, on what that is in layman's terms. It's just the person who owns a percentage of either a trust or a company. And so instead of it being I'm the sole owner, you would need that sort of company or that trust to be able to split the business where someone else buys in or it buys it completely from you. Am I on the right path there?
Relatively correct. I think it's more so, what you touched on is correct, but I think it's more so if you were to ever kind of sell your shares in the business in future, and whatever value that may be, it could be $50,000, it could be $50 million. Whatever share that you sell that for and whatever price you've sold that for, the third investor will purchase at that certain value, and they'll purchase however many shares you've sold to them. You will still own a portion of the company, but not only will you own a portion of the company, you now own that portion of the trust, a portion in the trust. But just on that as well, when you do sell those shares to an external shareholder and they've come in, they've bought a portion of the business, you have you've made what we call essentially a capital gain. You own those shares, you own the right to those shares. In the course of doing business, you've now sold those shares. And for a lot of people, when you do that, there is a capital gain that arises. So by having that trust, Zenia, that capital gain is actually better able to flow through to your trust. And then now you're better able to kind of not just say, right, well, this capital gain is all attributable to Zenia and you're going to pay your personal tax rates on this capital gain that you've made. You now have the flexibility to distribute that to a portion to your spouse. Maybe if your children are over 18 years of age, you have a portion to distribute to them because they're paying potentially tax at a lower rate. You might have beneficiaries down the line as well, whereby you might want to distribute a portion of that to them. It can get a little bit more convoluted if you start to distribute to individuals outside of your close family. The government's recently cracked down on a lot of this, and they're encouraging that the money, if it flows through to them per a tax return or on paper, there actually needs to be cash that follows along with that, and they need to benefit from that income, I guess you could say. But for a lot of kind of close, tight-knit families where you've got children, you've got a spouse, it makes sense to kind of have that trust structure set up for that flexibility.
Cool. And so if you have a child who's not yet 18, is there an age where you can start sending it to them before that, or do you have to wait till they become an adult?
So before the age of 18, you can really only distribute up to $416 to a child under that age. You can, in certain circumstances, distribute a lot more than that to the child. But the problem is, for most children under 18 years of age, they have to pay tax on any kind of income similar to this at a rate that's very, very high. It's normally the top marginal tax rate. And for a lot of individuals, it's just something you want to avoid completely. So $416 is the bare minimum that can be distributed to them. And then once they're over that age of 18, we can start to discuss more items and start to discuss potentially distributing a lot more to them if needed.
Okay, cool. And so just to go back on, like you've mentioned the word shares a lot. So my understanding is a share is just like a piece of a business. And so if I own all the shares, that means I own 100% of the business. And are shares typically out of 100? Like I might have, let's say I give someone 50% of my business, they have 50 shares, I have 50 shares. Is that how it works?
It's out of 100%. So,
okay.
You could have a business that has, 1.5 million shares, but if you own 10%, that's your 10%. I like to work off percentages. It's best to understand then.
Okay, awesome. I think the only other thing was you mentioned like trustee of the trust. So the trustee is the person who basically gets to choose where the money in the trust goes to. Is that right?
That's correct. Yeah. The trust kind of is the vehicle that owns all the kind of assets, all the investments, all the property, whatever it may be that is invested in that trust. That's what the trust holds. But the trust can't actually do anything unless the trustee goes, well, let's sell this item, or let's distribute this to this person, or let's invest somewhere else. They're the ones that have the true power over the trust, but they're also the ones that need to be across an understanding of the trust. And also they need to trigger to prepare a tax return at the end of the year and financials as well. So they have a lot more control, but they also have a lot more responsibility in that sense.
Okay, cool. Is there anything that you think that would be helpful for business owners to know as to how they can maybe keep more money in their pocket when it comes to tax time that we haven't spoken about?
Yeah, I think there's a variety of things probably to delve into. I think a good starting point is probably from a personal level, because I would say for a lot of new business owners just trading under an ABN, being that sole trader is probably the easiest step to start a business, and the easiest and probably most tax effective way as well. So I guess there's a variety of different things you can kind of delve into. I'll touch on a few items just to be so a lot of people are wary of, and maybe not a lot of people are wary of. First and foremost, I guess a big one that a lot of people kind of overlook, especially if they're just preparing their tax returns by themselves or not having an accountant. And once again, I would encourage, if you have a sole tradership, or even just another entity, definitely have an accountant prepare those tax returns and financials for you. It's not something you just want to wing and just do, because there's a whole bunch of things you can overlook. The first thing I see a lot of people kind of missing, especially in their kind of summaries they send over to us, is at the moment, especially since COVID, the government are imploring individuals that especially work from home or have a dedicated home office space. You can have two methods to go about claiming some of the hours that you're having to put in at home. So at the moment, the first method is the shortcut method. So what I mean by that is you can claim 67 cents as a deduction for every hour you've worked from home out of that dedicated workspace. Now, there's a whole plethora of rulings around that, and you need to make sure there is a dedicated workspace and you are actually incurring a lot of the expenses to run that workspace. But essentially, you're able to claim 67 cents for every hour, and that can be quite beneficial for a lot of, I guess, up-and-coming business owners that are operating a lot out of their home, and would like to claim a portion of that. Now, the second method is to go about claiming the actual cost of running that home office. So what I mean by the actual costs is it might come down to some of the occupancy expenses. So electricity, internet, maybe having to pay for heating and cooling of the room that you're operating out of. Some of those items we can all take into consideration and definitely factor those into your tax return. If it works out to be a little bit more beneficial to claim the actual cost, we often encourage to go down that route. the rulings around that can be a little bit more constrictive, and we need to undertake thorough checks of how much data is being used and how much internet usage and a whole variety of things. But it can sometimes work out a little bit better. If we're looking at the shortcut method of that 67 cents for every hour, it's often the quickest and easiest way just to get that deduction and provide that little bit more peace of mind for a lot of clients if they don't want to go down the route of having to work out, kilowatts per hour and stuff such as that. Because I'll tell you right now, it's not the easiest thing to do. I can tell you that.
Oh, goodness.
The second thing I encourage a lot of clients to do is contribute to your superannuation. I know for a lot of small business owners, super is just don't need to do it. I'd rather have the money in the back of my pocket. And especially for a lot of young people at the moment, interest rates being so high, people being on social media, they see all these kind of influencers doing really, really well. And they're like, right, well, I just want to keep that cash and I just want to grow and grow and grow. That's fine. But what I always encourage the clients is contributing to your super is the best way to get a tax deduction at year end. At the moment, you can get a dollar for dollar tax deduction depending on how much money you contribute. So if you contribute $5,000 to your superannuation in a financial year, that's a $5,000 tax deduction you get at the end of the financial year. It's just something I see great benefit in. Yes, it's money that for a lot of people, once you pay into your super, it's locked away, you can't really touch. But at least you can have the benefit of, first of all, knowing that you are growing your eventual retirement fund. And at the same time as well, you're getting a tax deduction year to year. So for this financial year, the 2024 to 2025 financial year, you can contribute up to $30,000 into your superannuation fund. Now, bear in mind that that $30,000 is inclusive of personal contributions that some individuals may want to make. And it also is inclusive of any kind of employer contributions that your employer has to make as well. So when you do this, it's always best to plan for this and speak to your accountant, especially to make sure you're not exceeding this cap. If you go over the cap, there's additional tax to pay, and it's something just best to avoid, I would recommend. But trying to hit that cap or at least contributing a portion of monies to your super is a really, really great way to legally lower your tax and, like I said, grow that retirement fund in future.
Awesome.
I guess another kind of thing to be wary of as well is depreciation. It's something that a lot of people probably relatively know because they might buy a car and they're like, oh, as soon as you drive it out the driveway, it's depreciated and you lose all value, but no one really understands the meaning of it. Essentially, what depreciation is if I go ahead and I purchase a vehicle, that vehicle, I'm allowed to claim the cost of that vehicle. So let's just say I bought that vehicle for $50,000. Unfortunately, I can't turn around and say, well, right, I'm claiming $50,000 as a tax deduction this year and I'm paying no tax. That's not how the ATO works. They encourage for a lot of people that car now has to be depreciated over several years. And what I mean by that is the cost of that vehicle will slowly lose its value over time, but you'll be claiming the actual expense that you incurred to buy that vehicle over that time. And you're able to kind of increase your deductions that way. So whilst using that example, $50,000 would have been spent in that first year and you're never seeing that money ever again until you potentially sell the car. At least you know in the back of your mind, you're getting that $50,000 over the next 8 years, for example, and that benefits reducing your overall tax. Now, depreciation isn't just limited to motor vehicles. You can also get depreciation on plant and equipment. So if you went out and you brought a whole bunch of equipment to run your business, a lot of that would often be depreciable. And the same goes for investment properties as well. At your personal level, you might want to start growing your portfolio. You might buy an investment property. I always encourage clients, if you've got a property that's less than usually 30 years, it's definitely very advantageous to discuss with your accountant or at least a quantity surveyor if a depreciation schedule would be beneficial to yourself. What a depreciation schedule allows you to do with a property especially is all of the equipment held in that property gets depreciated over how long the quantity surveyor decides. And as well, you also get depreciation on the build of the property. So if it's a new build, however much it may have cost you $250,000, you're going to get a portion of that back over time. And what we often see is people can get a deduction of up to $2,500 a year going forward. And that's money that you're not even seeing leave your bank account, but you're still getting a tax deduction for. So I'd probably say that's a very, very advantageous way to kind of lower your overall taxes. On that investment property, like the big one that a lot of accountants probably encourage everyone to do, and this obviously all comes down to cash flow, is to negatively gear all your investment properties. It's the best way to lower your taxable income, but at the end of the day, you're losing money. And you're losing money not only just on the interest that you're having to pay and all the expenses that you're going to have to pay to run this at a negatively geared rate, but you're also, if it's P&I, what I mean by that is principal and interest repayments on your loan, you're also having to pay principal repayments down on that loan and you're just losing a lot of money. So for a lot of people, it's not always the best route, But that is a great way to obviously lower your income tax. And unfortunately, where interest rates are at the moment, for a lot of people, their properties are very, very close to negatively geared, if not negatively geared.
Yeah, cool. And then the last thing that I think may be helpful to touch on, because I've definitely had some students inside our Biz Academy program ask me about this, and I feel like I bastardize it, and then I'm like, go speak to Matt. So please go speak to Matt if you're like, oh, I need some help with this. But paying yourself through dividends rather than through like payroll, or combination of both, can you, without like diving into like the franking credits and like, can you like surface level kind of just explain what that means?
Yes, yeah, absolutely, I can. So I think I'll highlight first and foremost, this strategy is only beneficial if you've had a business that is running at a really, really good profit. And what I mean by that is every year for, say, the last 2 to 3 years, your business has run at a substantial profit where you've been able to grow your retained earnings in the business. Now,
and so what is like substantial? Is that like $1 million? Is that like $10,000?
I think it's just to a point where the monies that you're making year to year in profit is actually enough to kind of subsidize a director's wage.
Okay.
So if a director wants to pay themselves $120,000 a year and you want to say, I don't want to pay myself wages anymore, I'd like to now draw from the retained earnings in the business and take home a dividend, then you should set yourself at $120,000 profit at least a year. That's how much you'd like to kind of run the business and get yourself by. Now, this strategy, like I said, is only beneficial when we start to see those retained earnings. And this is only applicable to a company, by the way. Companies are the only entities in Australia that can pay a dividend.
And sorry, finish
You're
the
right.
sentence first.
You're
I was
right.
going to say, what's a retained earning?
Yeah, of course. So using an example, if I own a company and that company has operated for 2 years, and in that 2 years, I've made $50,000 profit every year. By the end of the second year, if we add 50,000 and 50,000, I now have retained earnings in the business of $100,000. It's essentially the profits that aren't reinvested back in the company, that aren't spent. They're just retained in the company, and maybe they just sit in the company's bank account. Maybe they sit in a director's loan account, whatever it may be. That's the monies that have been made in that time and just sit there in that company for them. So by the end of that time period, that retained earnings there of $100,000, you now have the ability, and if especially the company has the ability to pay those types of funds. The bank accounts might be very, very healthy. That money might have just sit there and just may have been earning interest. You may have reinvested that in shares, but you might want to sell these shares in future, and you're better able to dip into these funds. A director might sit here at 1 year or in that third year using that example and say to himself or herself, I don't want to go about paying a wage this year of $100,000 to myself and having to pay super and having to pay pay-as-you-go withholding tax on this wage. Maybe I might lower my wage, still pay myself a relatively smaller value just for some of the services that I'm having to contribute to the business. But maybe I'd like to take a large portion of that home in the form of what we call a dividend. Now, what we mean by the dividend is you're, as a shareholder, not always as a director, but as the primary shareholder of that business, you're calling for a dividend and saying, well, I own a portion of this business and I would like to take a right of that dividend. At the end of the day, directors can only decide when a dividend is paid. Unfortunately, shareholders just can't kick and scream and say we want a dividend to be paid. So if you're a 100% shareholder of your own company and you're the director as well, you can pay a dividend whenever you like. And Zenia, in your situation, it was very, very advantageous for yourself. And for a lot of people probably following under your business model, I would imagine they're setting up similar entities to yourself. So in that instance, the director can go, right, well, we're going to pay a dividend this year and I'm going to access these funds to substitute my wages that I've been having to pay myself in the last couple of years and having to pay personal tax on. What happens is you pay that dividend, and depending on the shareholding structure, let's just use a simple example and say that, you hold the shares in your personal name. That dividend will essentially be paid from the company. And what I mean by that dividend is that retained earnings of the business, of using that example, $100,000, will be paid to the shareholder. And then in that shareholder's tax return, they'll have to report $100,000 as a dividend received. Now, just on that, and I don't want to baffle too many people, but there is when we pay a dividend in a company, there is what we call franking credits. Now, using that example, I've earned $50,000 for the last 2 years, $50,000 in the first year as profit and $50,000 in the second year as profit. The company's had to pay tax on that at 25%, and that's the company's already paid that tax. It's sitting there now in the company. That's retained earnings. It's already been taxed. Once that dividend flows through to that personal shareholder and they have to report that income in their personal tax return, the tax officer of the opinion, well, why should that shareholder have to pay 25% tax on that money again? So what the franking credit does is it flows through with the dividend to the personal shareholder's tax return. And essentially, they don't have to pay tax on the first 25% of that income. They may have to pay additional tax on top of that if they've earned more on that income, and they get taxed at a personal tax rate which is higher than 25%. And for a lot of people, that is the common case. But at least a lot of shareholders can have the benefit of knowing that they don't have to pay 25% tax on the first 25% of that amount.
Cool. So just to clarify, let's say that I was at 32% personally, and I'm paying, $100,000 this year as a dividend to myself from my own business. The company's it's retained earnings, so the company's already paid 25%. So therefore, when I give it to myself, I only pay the remaining, that 7% buffer. So I'm not double dipped, and that money becomes my personal money. It doesn't have to stay in the bank account, and I can the business, and I can spend it on whatever I want.
Correct. And like if you're earning a whole bunch of investment income on top of that, the tax rate's going to slowly increase, of course. But using a very, very basic example, if that's all the money you've made for the year, that $100,000, then that would usually be the tax rate you'd have to pay. And only that small difference would have to be paid essentially, because the franking credits would accommodate for that first 25%. So very, very advantageous for shareholders, and very, very advantageous for those directors that own 100% shares in businesses. It's a great way to kind of lower your overall, making the business or the company pay a large portion of the taxes that are being made on that monies, and you not having to cop that personally at a higher tax rate. But at the same time as well, for a lot of people, they're also saving on those super contributions and pay-as-you-go withholding tax contributions, because maybe their intention at that age is to hold a little bit more funds for themselves and have that personal investments that they'd like to invest into.
Awesome. The only other thing that I think might be useful to touch on is how, as a company, I can give myself a personal loan and then not have to pay interest if I want to basically take money out of my business, give it to myself personally, and then pay it back. Can you talk through that?
Yeah, absolutely. I think the first thing to understand with a company is it's very different to a sole tradership or an ABN business. So when a lot of people start off under an ABN, whatever money's made and whatever profits are made, that's your money. You get to take that home under an ABN. You can spend it however you like. You're more discretionary. It's great. But obviously, for a tax perspective, you might get to a point where I want to switch to a company because I want to save on tax and I want to be a little bit more asset protected. Once you switch to a company, it's very, very different to get money out. The only real ways to get money, especially out for a director and a shareholder of a company, is through the form of paying yourself either a wage, paying yourself through the form of a dividend, which obviously you've got to first and foremost be dependent on the company being very, very profitable and paying a lot of tax first. Or the third option is, like you touched on, Zenia, just withdrawing funds from the company and transferring it straight to your personal account and taking it home. Now, there is a first and foremost, I like to encourage your clients to be wary of this. For a lot of clients that switch from sole tradership, so an ABN business, to a company, they just keep operating like they always have. They just withdraw as much money that's left over to their personal bank accounts.
I'm sure that's like a headache for you.
Oh, it is. And it gets
You're
to
like,
a point
no.
And the reason it's a big no-no is it gets to a point where, using that example earlier, there might be $50,000. You just transfer straight to your personal account. You're like, sweet, this is my money. I'm going to spend it. The problem is that because the company's treated as a separate entity to yourself, that's $50,000 you now owe back to the company because you haven't paid any tax on that money. You haven't paid it out in the form of a dividend. It's just a big no-no. And what can happen is, if we get to the end of 30 June and that $50,000 is still sitting there and it hasn't been repaid to the company, what the ATO does is they'll now enter you into a loan agreement whereby you'll have to pay that back over several years, usually 7 years, and you'll also have to incur interest on that amount. And I believe the interest rate for the moment that the ATO has set is over 8%. So it's very, very high compared to a lot of bank loans and a lot of investment loans especially. So I like to encourage a lot of clients, let's avoid that. If you're going to take $50,000 out of the company, let's either discuss paying yourself a $50,000 wage for the year. Let's discuss potentially putting a little bit of that money into your super. Maybe we discuss paying yourself a dividend if you're able to. Or the third and final solution is, if you still have that $50,000 personally in your personal monies, potentially it's sitting in an offset account, maybe it's sitting in a personal investment that you'd like to withdraw, please repay that money before 30 June so that the company's debt is kind of repaid and you're not having that lurking over your head. Now, on that third example I just presented of the offset account, a lot of clients, especially as of recent with interest rates being so high and, the housing market was pretty good over COVID, and a lot of people kind of bought up property and did really, really well. But now they're getting to a stage where people are coming off fixed rates onto variable rates, and people are hurting at the moment. So having an offset account that's kind of pretty much offsetting any kind of high interest you're having to pay on loans is really, really beneficial. So what we're seeing is for a lot of company shareholders and a lot of company directors, they're deciding that maybe the money's retained in my company or in my company's bank accounts. Maybe they're better held in my personal offset accounts just to kind of save on the higher interest rates. So for a lot of people are transferring some funds from their companies to their personal bank accounts, having it just sit there in an offset account, saving on interest for the year, and then making sure that monies are returned to a company by prior to 30 June. So we like to show that, yes, that company's been repaid and that debt's no longer hanging over their heads. And now there is a lot of ruling around this, and I highly encourage a lot of people to speak to their accountant first before going down this process. But it is something that definitely can be beneficial to some people. But just making sure you follow the regulations and making sure as well that that debt is being repaid, it can be obviously quite advantageous. Now, that was an example of what we call a debit loan. So a debit loan is essentially you've withdrawn money, that money's still owed back to the company. The opposite side of that example is what we call a credit loan. So that's money that the company actually owes. That's money that the company actually owes to the director or to the shareholder. So the most common example we see is when a company's first set up, the sole shareholder and the sole director obviously has to pump some money into the company personally just to get it off the ground running and to get it going. If I'm to contribute $50,000 into my company to get it running, what will happen is that's a $50,000 loan that I now have presented on my financials for the company, and that's $50,000 that the company owes back to myself over time. Now, in that time, I might want to say to myself, right, the company owes me $50,000. Maybe I don't have to pay myself a wage. I might just have the company pay those funds back to myself, and I'll subsidize that as a wage for the year. For a lot of people, a credit loan is very, very advantageous because it's money that you've already had to pay personal tax on. It's money that you've just kind of used to start your company up, and it's money that you're entitled to. So using your credit loan is first and foremost the most beneficial. But then when a credit loan's kind of tired and you're down to that zero value and start to creep into more of a debit loan, that's when we need to start being more wary of paying yourself wages or dividends or that last option of discussing with your accountant and making sure if it's maybe the most viable way to go about accessing those funds.
Amazing. I feel like there's like my brain would be hurting if this is the first time that I'd heard this information. So I'm glad I could like somewhat keep up. But you know, it's been probably like 4 years, 3-4 years we've been working together now. So yeah. I feel like I'm relatively on top of it. But I think at this stage, anyone who's listening who's going like, oh my God, that's well and truly above my knowledge limit, then that's okay. I think we're not in business to be accountants. We're in business to make money, and then the accountants get to help us with these conversations. And I definitely didn't start out being like, oh, I know what a trust is and a franking credit and all these sorts of things. And I still, to be honest, don't really know. And I feel like some of these terms are a bit elusive even to accountants. But my recommendation is if you just want to understand where you're at in your business from a financial perspective a little bit better, or you have a specific question about anything that we spoke about today, I'm going to make sure that we put a link to you and ProYou in the show notes. Please mention my name, mention Zenia when you do have a chat. Matt has graciously gifted us an hour complimentary consultation to anyone who listens to this episode and just wants a little bit of advice. Maybe you're not sure if your accountant is the best accountant for you, or you've never had one, or you just have some structuring questions. So I just wanted to make sure that please do that. I don't even know. It's in probably the 20s of the number of people that I've referred to you now, because I just can't stop raving about you. I laugh about I think I told you this. I met some girl in the bathroom of all places at an event, and she was like, I hate my accountant. I was like, babe, let me give you my accountant's details. So I literally can't, any opportunity to pass on your details, I do, because I've never had a bad word from anyone who I've sent your way, and everyone is just head over heels in love with what you guys do. So really thank you for actually stepping up for, business owners and for presenting this new school method that actually allows us to feel confident and comfortable to chat to our accountants. I really appreciate it.
Yeah, no, I really appreciate that, Zenia. And yeah, the referrals that have come through from yourself, I'm sure they'd probably all attest. The way we're doing things it's very, very different, but it's very, very different in a good way. And like I touched on earlier, business advisory is so important to business owners. And I think having that strong relationship with an accountant, not only that you trust, but also that you're not intimidated by, you can call at any time, you can email at any time. It's so, so important just to make sure that you're across some of the items that we've discussed today. Or if you're not across any of those items, at least you know your accountant's across them, and you're better able to kind of just operate your business the way you want to operate. So more than happy to take those calls going forward. If anyone out there is kind of looking for assistance, like Zenia touched on, we do offer that 1 hour, no obligation consultation. So in that meeting, we'll understand what kind of business needs you're after. We'll also understand your plans for the future, where you're going in life, not just from a business perspective, but also from a personal perspective. And we can discuss some very, very high level kind of conversations in terms of maybe bettering your business and seeing how we can kind of provide services in future to better assist you. I think that's probably invaluable for anyone out there looking for help.
Absolutely. Even if you like love your current account and you just want some advice and, you know, maybe you keep Matt in your back pocket for a rainy day, I think it's definitely worthwhile. And so we're going to put it in the show notes, but where is it best for people to find you and have that conversation?
Yeah, absolutely. I think accessing our website is probably first and foremost the best way to do so. So just on Google or any kind of search engine, www.proyou.com.au. It's invaluable to kind of go on that website, better understand our people, better understand our kind of goal when it comes to operating our business and looking after our clients. Once you're kind of across that, you can kind of look to book a consultation through that website. I'm sure Zenia will also put my personal details down. So if you need to kind of access us directly or shoot through a message that way, more than happy to kind of assist with any follow-up questions from today's conversation. The same thing I want to touch on as well, and Zenia touched on, we've obviously been operating now for over 4 years and working with Zenia for pretty much the close amount of time. Zenia's operating up in Queensland. We're based down in Parramatta in New South Wales. That really forms no kind of barrier to our kind of services that we're providing. We currently offer not just services to clients in Queensland, but clients down in Melbourne, WA, Northern Territory, South Australia, pretty much all across Australia, and starting to form relationships with clients actually internationally as well. So please don't think that I'm not operating out of New South Wales or I can't go see Matt in person. We highly encourage that. We're more than happy to jump on a Teams call or just over the phone or via email. The modern world these days has made it so much easier for us now to form those relationships with people in very, very far distances. So please don't hesitate to reach out if you're in another state or another country.
Amazing. Amazing. Thank you so much for your time today. I hope that anyone listening has taken even just one new thing away from that and then opened their eyes to maybe there's more things that they could learn with this that will help benefit them in their business future. Have a fantastic day, Matt. And I get to see you actually in person. Like, I don't think people realize this, but like I actually like my accountant. We like hang out, which is so weird. It's like if you're friends with your dentist, you know, like the people you don't really want to talk to, but I think it's great. So I will see you. It's this Friday, right?
This Friday.
Amazing.
Yep.
So good. And we're going for a gym session, just so everyone knows. So Matt's also into health and fitness, and he was like,
Yes,
"Oh, I've never had a gym session like as a meeting before." And I'm like, "Yeah, I do it all the time, like walking session." It's just, yeah, you know, when you get inducted into the fitness industry and the world of me, then we do things differently too.
No, I love it. I'm looking forward to it, Zenia. Thank you so much.
Oh, amazing, amazing. Make sure you come prepared for that session. I'll have to make it hard for you.
I will.
All right. See you later, Matt.
See you, Zenia. Bye.
Just a quick reminder before you go, that link is waiting for you in the show notes if you are a health coach who is in business looking to grow or scale. We have options for both, and I am super excited to be working with a few individuals next year who are ready to take their business to the next level. If that sounds like you, chuck down and have a look at the show notes and you can apply through there, and I will talk to you one-on-one and we can figure out if this is right for you. I cannot wait to chat. I have a tiny favor to ask of you, and that is to just hit that subscribe button if you have not done it yet. If you've made it this far, then I hope that this has been valuable for you and for us to get more incredible guests in front of your earlobes and faces. If you're watching us on YouTube, then please do that now. And if you have any feedback or suggestions for me or something that was a golden nugget that really stood out to you in this episode, I would absolutely love if you flicked me a message over on Instagram at Zenia Wood Official. Until next episode, and in whatever you do, move swiftly.